Mr. CEO, today we're meeting to review our offer and potential acquisition of Sun Microsystems. Now I'm going to turn it over to Stephanie to kick us off.
The strategic rationale for this acquisition includes 5 key points. 1, the complementary technologies which can provide integrated solutions for both hardware and software. 2, the market expansion which can develop Oracle's perception as a one-stop shop for business clients. 3, key offerings like Java continue to be leveraged, and new products like MySQL can appeal to customers on the lower end without cannibalizing the product line. 4, cost strategies that continue to demonstrate Oracle's track record of cutting costs for streamlining operations and improving profitability. And lastly, to safeguard against competitors like IBM swooping in to claim Sun Microsystems. To do this, we chose to look at 2 valuation approaches: discounted cash flow as well as multiples. We chose to use the DCF method because of its fundamental capabilities in analyzing intrinsic valuation, as well as showing a long-range earning potential, and allowing the team to customize our assumptions, which Chris will be sharing shortly. We also chose multiples, because given the timeline and our desire to double-check the numbers this weekend to prevent a possible bid by IBM or another company. In addition, it is a straightforward approach, less sensitive to assumptions, which provides a healthy contrast to the DCF. Next, Chris will go over the DCF.
Thanks, Stephanie. Mr. CEO, I'd like to start by reviewing our discounted cash flow analysis to create a range of valuations for Sun Microsystems. Our projections indicate positive annual cash flows from 2010 to 2014 with values of $503 million, $360 million, $502 million, $536 million, and $567 million in 2014. We recommend a required return rate for Oracle of 12.15%, which is 4% more than the weighted average cost of capital of 8.15%. The terminal value is approximately $10.3 billion, while the enterprise value is $8.9 billion and the equity value is $8.8 billion, which is 80% more than the current market value of $4.9 billion. Some of the assumptions driving this model are a growth equal to the GDP of the United States, the EV/EBITDA multiple of 7.2, which is an average of Sun Microsystems competitors, and a market rate of return of 6%. This valuation prices Sun Microsystems at almost $12 per share. In the data table to the right, you can see our range analysis where even the worst case scenario price is almost 50 cents per share more than the current stock price of Sun. We have highlighted in the green box a conservative sub-range of values between approximately $9 per share and $13 per share. We think this makes Sun Microsystems a good value. My colleague Robert will discuss the results from our multiple analysis.
Thanks, Chris. We've chosen EV to EBITDA as a key metric here to help compare industry competitors. EV to EBITDA, or enterprise value to earnings before income tax, depreciation, and amortization, helps to place a valuation on a company through a multiplier. In this case, having benchmarked several industry peers and Oracle ourselves, we've come into a rough average of a little over 7x multiplier. What this helps to suggest is companies above 7x in our industry would be overvalued, or under 7x multiplier would be undervalued or fair valued. Take IBM, for example. An EV to EBITDA ratio of about 5.68 versus an industry average of a little over 7x would suggest that IBM is undervalued in this instance or with this metric. EV to EBITDA is a helpful metric because it's independent of a firm's capital structure. It's simply comparing market cap, debt, cash, which calculates your enterprise value, and then determining the ratio with your EBITDA or earnings. Now, obviously, in 2009, Sun Microsystems has fallen on a little bit of a hardship and is actually recording a loss for the year instead of a profit. Now, having even looked at the 2008 metrics, EBITDA for Sun Microsystems last year was relatively small, and with razor-thin margins, that metric is a little bit skewed. But nonetheless, these benchmarks across the industry help provide key insight as to valuing a firm here. And in this case, with Sun being a relatively low number, might suggest that this could be a good time to buy the company as they are not recording much margin, and obviously their multiplier is way below industry norms. Now I'm going to turn it over to Will to talk about synergies with this acquisition.
Regarding synergies analysis, we've identified several. The first is cost reduction synergies. We hope to streamline Sun operations, reduce redundant staff, and close or consolidate data centers. Our second is revenue enhancement synergies. We would combine our enterprise software with Sun's hardware and their software, such as Java and Solaris. Financial synergies, we would leverage Oracle's stronger financial position to reduce the overall cost of capital for the combined companies. And finally, tax synergies. We could take advantage of Sun's accumulated net operating losses to reduce our taxable income. Here we look at synergies in a sensitivity analysis. In our table, we show 3 scenarios, all calculated using an 8.15% cost of capital. In the first scenario, if Oracle were able to obtain a 10% cost reduction, we could save $500 million annually, leading to a net present value of $2.3 billion. If a 20% cost reduction were possible, the savings grow to $1 billion per year, resulting in a net present value of $4.6 billion. In the 30% cost reduction scenario, Oracle could save $1.5 billion annually with a net present value of $7 billion. When it comes to competitive bids versus our maximum bid, we present an analysis of our maximum offer price for the acquisition of Sun based on different scenarios and synergy estimates from the previous slide. But first, we defined the simple formula for calculating the maximum offer price. It is the sum of Sun's standalone valuation plus the net present value of the synergies that Oracle can realize. We also included Sun's current market cap of $5.3 billion to show the premium Oracle would be paying in each scenario. In the table, we present 3 scenarios. Scenario 1 from the previous slide shows Sun's standalone value brings Oracle's maximum bid to $7.6 billion. In scenario 2, the maximum bid is raised to $9.9 billion. And finally, in scenario 3, Oracle could bid up to $12.3 billion, assuming 30% cost reductions were attainable.
Mr. CEO, today our team is ultimately recommending that we move forward with an offer and potential acquisition of Sun Microsystems. We believe that Sun's technologies would complement our existing portfolio offerings very well. We also believe that we would achieve significant synergies and potential cost reductions, leading direct value and profitability to our shareholders. And at this time, given current financial circumstances and prices, we believe that Sun is quite fairly valued or even undervalued. We think Sun would ultimately make a great purchase and a great addition to Oracle's portfolio.